Hey, Matt here. Happy Monday. Just a quick update on what's going on in the markets. Obviously, lots of volatility here. If we look at the spreadsheet, market odds for a rate cut uh, this month have increased over 50% now as of Friday. So we'll get updates on that as we move through this week into next. So that's primarily driven by the employment data that came out, which is very poor in terms of uh, uh, the economy. So what we saw was actually full time. I'll put a chart. I'll put a chart as well. But we saw full time employment reduce quite significantly, and unemployment rate continues to trend up. So the one thing that we want to keep an eye on, which we put in here, are the bond yields, because April 16th is that next announcement. But the bond yields are just very volatile, right? If we see day over day, we could see over the last. Actually, let's even just dive in a little bit closer in terms of hours. But we could see we've seen upward trend even this morning and down up. So quite a bit all over the place. So it's really hard to predict where that's trending, where that's going to go. One thing that we might see tighten is that discount off of prime for variables. So it's always good to look at securing that discount if you're in looking to get a mortgage right now. So that could be something to take a look at in terms of locking in. Where do fixed rates go into the future? Hard to predict, but there seems to be some volatility out there. I don't think we're anywhere near concern of rising interest rates at this point, right? We have to generally see prolonged trends for that to happen. So things are pretty um, quote unquote stable, let's say within that 2.5 to 265, 270 range for the last little while here. So I'm sure we'll see stability in the markets. I don't think we're going to see any significant downward pressure on interest rates because those spreads, if we jump back to the spreadsheet here, we could see those rate to spread to yield spreads, which usually were in that 1.5% plus or minus, right? Is traditional. If we want to look at just historical, is you can see just over that on the uninsured, just under on the insured. So what we're used to since that insured uninsured rate change years ago. So any questions you have, always here to help. Just let us know. It's a wild time. Markets are all over the place, and interest rates, no real concern of immediate changes. Looks like we might be trending towards a potential another rate cut this month, which was not the consensus even just a week ago. It was trending towards probably of a rate hold. Could still be the case, but two things that generally influence that would be full time employment reductions is going to have immediate impact from the Bank of Canada. They're going to look at that closely, and then they're also going to look at different metrics which seem to be trending more in their favor, which is uh, wage wage growth is reduced. So that's actually something that they like. Not good for obviously us, but in terms of long term rate outlook, the question is: does the full time employment drop outpace and help inflation, so inflation doesn't ramp up and become persistent? Is it just a short term upward pressure on inflation, and then downward pressure given reduced spending, more unemployment, less full time jobs? Those sorts of things could put downward pressure on inflation, and that'll be something we want to keep an eye on. The markets are predicting probably a half to 3/4% reduction from the Bank of Canada over the course of this year at some point. So we might see that overnight rate settle in the 2.25-2% range um, by end of year if things trend that way. So interest rates are quite good. Especially what we've seen over the last few years, but a lot of uncertainty, and that's for good reason. But it's definitely a very good buying opportunity if you're out there looking to purchase a property. This could be a good opportunity over the coming weeks. So, any questions here to help? Have a great day, great week. We'll talk to you soon.